If you've ever applied for a loan, rented an apartment, or wondered why your interest rate is what it is, this series is for you. We're going to walk through everything you actually need to know about credit, what it is, how it works, how it's calculated, and how to make it work for you. Here's what we cover in this series. What credit is and the two forms it comes in. What your credit report contains and how it's built over time. What your credit score is, how to access it, and which bureaus to use. How FICO scores are calculated. Why good credit matters beyond just loan rates. Common misconceptions that trip people up. And practical steps to improve your score starting now. Let's start at the beginning. Credit is your financial reputation. It's the trust that when you borrow money, you'll pay it back. The stronger that reputation, the more lenders trust you, and the better the terms they offer. Credit comes in two forms, secured and unsecured. Secured credit is backed by collateral, your car, your home. Because the lender has something to fall back on if you don't pay, they can offer larger amounts at lower interest rates. If you stop making payments on a secured loan, the lender has the right to take that collateral. That's why a mortgage default can mean losing your home. Unsecured credit has no collateral behind it. Think credit cards and personal loans. Because the lender is taking on more risk, interest rates are higher. If you stop paying unsecured debt, you won't lose property, but your credit score takes a serious hit and the account goes to collections. We'll cover what that means later. The key thing to understand right now, credit is a tool. How you use it determines what it costs you and what doors it opens. Your credit report is the full record of your credit history. Every account you've opened, every payment you've made or missed, every time someone has checked your credit. It starts building the moment you open your first credit account, and it keeps going from there. Here's what your credit report contains. Personal information, your name, address history, social security number, and date of birth. Existing credit accounts, every credit card, loan, and line of credit you've had, including current balances and account status. Payment history, whether you've paid on time and any missed or late payments. Public records, things like tax liens or bankruptcy filings. Credit inquiries, a log of who has requested your report and when. One thing that surprises a lot of people, old accounts you haven't touched in years still show up on your report. And in most cases, that's actually a good thing. Closing an account doesn't erase it, but it can shorten your credit history and reduce your available credit, both of which affect your score. We'll get into exactly why in the FICO section. Your credit report is available for free once a year from each of the 3 bureaus at freecreditreport.com. That's 3 free reports per year. A good habit is checking one bureau every 4 months, so you have a current picture year-round. Your credit report is the full story. Your credit score is the summary. It's a 3-digit number, typically between 300 and 850, that tells lenders how likely you are to repay what you borrow. The higher the number, the lower the risk you represent to a lender. Your score is used for most everyday lending decisions. Car loans, credit cards, personal loans. Your full credit report comes into play for larger decisions, like a mortgage, where lenders want the complete picture. There are 3 major credit bureaus that track your credit: Experian, Equifax, and TransUnion. Each one collects and reports your credit information independently, using slightly different methods. That's why your score may vary a few points between them. It's worth checking all 3 periodically, not just one. Here's a quick breakdown of each bureau. Experian focuses heavily on your credit score on the main dashboard and shows your full Experian report. They also offer Experian Boost, which lets you add on-time utility and phone bill payments to your Experian score for a small fee. It can help, but only if those bills have a clean payment history. Equifax is known for its credit monitoring and identity theft protection tools. It's straightforward to navigate and gives you both your score and report history. TransUnion uses the VantageScore model instead of FICO. Some lenders specifically use VantageScore, so it's worth keeping an eye on your TransUnion report, even if it's your third stop. If you have an EdiFi Keep Safe checking account, you can view a snapshot from Equifax directly through the Club Checking app or at keepsafe.clubchecking.com. A note on Credit Karma: it's free and widely used, but it earns revenue by promoting credit products, and as a result, it tends to report your score slightly lower than the bureaus. Use it as a general reference, not your primary source. You can also freeze your credit directly through each bureau's website. A freeze blocks anyone from pulling your report, which is one of the most effective ways to protect yourself from identity theft. FICO is the most widely used credit scoring model. Developed in 1956, it's the score most lenders look at when making lending decisions. FICO scores range from 300 to 850. Above 670 is considered good. Above 800 is exceptional. Your FICO score is calculated using 5 factors. Understanding each one helps you know exactly what moves your score up or down. Payment history makes up 35% of your score. It's the single biggest factor. One late payment can have a meaningful impact, especially if your history is otherwise clean. Amounts owed accounts for 30%. This is your credit utilization, how much of your available credit you're currently using. Keeping that number below 30% is the general guideline. Below 10% is even better. Length of credit history is 15% of your score. This is why closing old accounts, even ones you rarely use, can hurt you. The longer your history, the better. New accounts and inquiries account for 10%. Every time you apply for new credit, it registers as a hard inquiry and causes a small, temporary dip in your score. Applying for several accounts in a short period amplifies that effect. Types of credit make up the final 10%. Having a mix of credit types, such as a credit card, an auto loan, and a mortgage, signals to lenders that you can manage different kinds of debt responsibly. A quick note on those old accounts. Closing a credit card you haven't used in years might feel like good financial hygiene, but it can actually lower your score. It reduces your available credit, which raises your utilization, and it shortens your credit history. If there's no annual fee, the better move is usually to keep it open. And never close your first credit card. That account carries your entire credit history with it. Good credit saves you money, that's the bottom line, but the difference it makes is larger than most people realize. Here's a real example. 2 people buy the same used car. Same price, $20,000. Same loan term, 60 months. The buyer with a credit score of 720 or higher gets an interest rate around 5.5%. Their monthly payment is $382. Total interest paid over the life of the loan, $2,921. The buyer with a credit score between 525 and 624 gets an interest rate around 12%. Their monthly payment is $445. Total interest paid, $6,993. Same car, same loan length. A difference of $3,772 in interest because of credit score alone. And that's one loan. Multiply that across a car loan, a mortgage, and credit cards over the course of a lifetime, and the number gets significantly larger. Credit affects more than just loan rates. Some employers check credit as part of a background screening, particularly for roles that involve financial responsibility. Landlords use it to evaluate rental applications, and in many states, your credit score is a factor in calculating your auto insurance premium. Good credit isn't just about borrowing, it's about options. The better your credit, the more flexibility you have in the financial decisions that matter most. Before we get into how to improve your score, let's clear up a few things that trip people up. First, soft and hard inquiries. A soft inquiry happens when you check your own credit, when an employer runs a background check, or when a lender pre-screens you for an offer. Solved inquiries do not affect your credit score. A hard inquiry happens when you apply for credit. Applying for a credit card, a car loan, or a mortgage triggers a hard inquiry, and it does cause a small, temporary dip in your score. One exception: if you're shopping for a mortgage or auto loan and submit multiple applications within a 14-day window, the credit bureaus treat all of those as a single inquiry, so comparing rates won't hurt you the way applying for several credit cards in a row would. Now, a few common misconceptions. Debit card payments do not affect your credit score. Debit is not credit. Your checking account history is not part of your credit score. Student loans don't factor into your score until repayment begins. Once you start making payments, they do. Utility bills, phone bills, and cable are not part of your credit score, unless you stop paying them and the account goes to collections. The exception: if you add them through Experian Boost, they can help your Experian score. Your interest rate doesn't affect your credit score, but your credit score absolutely affects your interest rate. One more that deserves its own moment: bankruptcy. Filing for bankruptcy is the single most damaging thing you can do to your score. Chapter 7 and Chapter 11 bankruptcies remain on your credit report for 10 years. Chapter 13 stays for 7. There is no shortcut to removing them. You wait. Most other negative information, like a collection account, stays on your report for 7 years. Whether you're just starting to build credit or you're working to repair it, the fundamentals are the same. There are no shortcuts, but there are clear steps that work. Pay on time, every time. Payment history is 35% of your score. A single late payment can have a real impact, particularly if your history has been clean. Set up auto pay for at least the minimum on every account, so you're never caught off guard. Keep your credit utilization below 30%. If your total available credit across all cards is $10,000, try to keep your combined balance below $3,000. Below 10% is even better if you can manage it. Don't close old accounts. Even credit cards you never use are helping you. They add to your available credit, which keeps utilization low, and they extend your credit history. If there's no annual fee, keep them open. This goes double for your first credit card. That account anchors your entire credit history. Do not close it. Space out new credit applications. Every application triggers a hard inquiry and a temporary dip in your score. Applying for several accounts in a short period also signals risk to lenders. A good rule of thumb: wait 6 months to a year between applications for new credit. If you're newer to credit, a secured credit card or a credit builder loan can be a good starting point. You're building a payment history with manageable risk. And check your credit report regularly. Errors happen, and a mistake on your report can drag your score down through no fault of your own. You're entitled to a free report from each bureau once a year at freecreditreport.com. Dispute anything that looks wrong. None of this is complicated. It just takes consistency. Good credit is built the same way everything else is, one decision at a time. EdiFi Credit Union. Know more, grow more.